Hello everyone, so today I'm going to be covering a new company. It's called Nutanix. This is going to be a stock analysis video, so let's get right into it. So first I'm going to explain how the business works, how it generates money, and then we'll go to earnings and then the other financial aspects of the company. But to start off, it's a cloud computing company. And I actually was watching a YouTube video just to catch up, just to remember everything that it specifically does. They do have their own YouTube channel, and there's a short video, it's about 4 minutes long, I was watching before this, to just pretty much summarize how they what they do specifically, their data management, their network tools, all of those things, their cloud support, everything. And we're gonna break it down a little bit here as well. So in simpler terms, this means that they provide software that simplifies and streamlines how business manage their IT infrastructure, particularly focusing on data centers and supporting hybrid multi-cloud deployments. Their products aim to converge compute, storage, networking, virtualization into a single software-defined solution. This approach helps organizations reduce complexity, improve efficiency, enhance performance, and support cloud-native applications. So some of them that some clients of theirs are Walmart, Amazon, the big guys, big businesses generally speaking, but even small to mid businesses that are growing will use this software as well. So how do they make money, which is obviously the most important thing? They generate money through subscription-based software model. Software subscriptions, businesses pay a recurring fee, often annually or multi-year, for licenses to use Nutanix's cloud platform, which includes its hybrid converged infrastructure, software, and other specialized products like virtualization. They have support and professional services, and then hardware pass-through. So just keep in mind that it's pretty much a subscription service, and they go by ARR, which is annual recurring revenue. The same goes for CrowdStrike because it's a cybersecurity company. Same with Palo Alto Networks, SentinelOne as well. ARR is really one of the more important metrics that you have to go by, because as more people sign up, that number is going to increase, and you're going to see it reflected in the earnings right now, actually. So the next thing I want to show is the earnings, which came out. These are old earnings, May 28th of 2025. The new ones come out for Q4 because they're a little bit ahead for 2025. I believe August 26th. So I'm going to cover that then, but I do want to just take a look now and see how they did in the past, and they did quite well for this earnings report. Their adjusted EPS was 42 cents, exceeding the consensus of 38 cents by 4 cents. This represents a 50% increase year over year. They also had great revenue growth. Quarterly revenue rose 22% year over year to 639 million, beating annual estimate of 626 million. Their ARR, annual recurring revenue, also grew 18% to 2.14 billion. However, this is slightly below Wall Street analyst projections, but still very substantial. New customer growth, added 620 new customers. Free cash flow, the company reported free cash flow of 203 million, representing a 32% margin. And then guidance was great. Nutanix issued revenue guidance for the fourth quarter of fiscal year 2025 between 635 million and 645 million. The company also raised its full fiscal year 2025 guidance, projecting revenue between 2.52 billion and 2.53 billion. Despite the earnings beat, Nutanix's stock saw a slight decline in aftermarket trading. However, the stock had advanced 29%. So analysts are very optimistic about it. Obviously, the numbers are crushing it. So I don't think long term it's something to worry about, but we have to see if it's expensive or not at these current prices, of course. Next thing I'm going to show, free cash flow growth. Excellent. 2021 negative 158 million, now positive 766 million. Fantastic. It's been growing year over year. This is exactly what you want to see from a company, and it looks like it's really not stopping at all in the slightest. So great, nothing to complain about there. We're going to check Simply Wall Street, and Simply Wall Street's also going to be very good as well. 766 million, like I said, and by the middle of 2028, because it's July 30. 1.3 billion. So let's say it's a double. That's a great double, and it looks very good. The free cash flow looks amazing. So again, no complaints really. If we check the financial health of the company, this is where it gets a little sketchy here. Short-term liability. So it has negative shareholder equity, which is a more serious situation. The short-term assets not covering short-term liabilities. It has negative shareholder equity, which is more serious. Yeah. So for some reason, they do have a lot of negative shareholder equity. So you do have to be careful. And remember, because the blurb is right here, and I've said in previous videos, but negative shareholder equity is when a company's liabilities exceed its assets. A company should typically have positive shareholder equity where it has more assets than liabilities. All right, so just keep in mind that this company does have a bit of an issue with this. If we check my DCF on it, my DCF is going to say it's 1% undervalued currently. If we check Wall Street forecast, however, which I think is a little more accurate, it's 10% undervalued. So it's slightly undervalued, I would say, which not bad at all. And if we check Tipranks, which I got to load up super quick, it's going to be strong buy, 13 buys, 2 holds. So it does look like a good, decent bet, but the shareholders equity thing, that makes me pause a little bit. That I don't like too much either. You have to be very, very careful, I think, with this company because of the negative shareholders equity. It's a metric that you can't really ignore on this one. All right, thank you, everyone.